The TEK2day podcast is brought to you by SS&C Technologies, a global market-leading provider of cloud-based investment accounting software services in fund administration. SS&C's AI-powered investment operations and accounting platform, Singularity, provides real-time, multi-basis accounting across a wide range of asset types with unparalleled automation and operational efficiency. Singularity is offered on a software-as-a-service basis or via SmartSource, SS&C's intelligent middle and back office accounting service. For more information, visit ssctech.com/singularity. Welcome to the TEK2day podcast powered by CEO Rater. It's your host, John Mayetta. Check us out online at ceorater.com. Anonymously rate your company, rate your CEO. Visit us at TEK2day.com, TEK2day.com for the latest in capital markets related content. You've probably heard me on the podcast before be critical of companies on the M&A side that either pay too much for acquisitions or don't do a good job of understanding the strategy that underpins the rationale for an acquisition, strategic rationale as we call it. I've been critical of companies in the past on the post-close integration side, companies that don't do a good job of, for example, technology integration post-close, cross-training the sales forces, how you're going to go to market with the combined company, how are you going to channel the acquired asset through the installed base to get maximum leverage and things of this nature. And one of the things I'm not sure that I've talked about in the past is frothy markets like this and trying to get deals done for quality companies, and it's tough because everything's expensive. And one way around it is, to try to leverage your equity to the extent that your stock is richly valued. Use as much stock as you can to get a deal done to help mitigate the impact of a target being richly valued, let's say. So not wanting to deplete your cash store, equity is a way to help mitigate cash depletion. So I wanted to give an example. So what was it last week? Roper Technologies, ticker ROP, acquired a company called Vertafore, or they announced the deal. They didn't close the deal. Vertafore plays in the P&C insurance space. It's one that I got to know a little bit when I was an investment banker. It's one I took a casual look at, or rather met with its former owner when I was on the corp dev side. And at that time, it was basically a flat revenue business with a substantial debt load. I don't remember off the top of my head, but it was private equity owned. And as of year-end calendar 2018, per a Moody's credit report that's out there in the public domain, Vertafore was levered at 11 times debt to EBITDA as of year-end 2018, and that calculation, as detailed in a note, was if you unwound the capitalized software. But in any event, it's a large debt to EBITDA multiple, 11 times. And so Roper acquired this thing. My guess is that Vertafore is still right around flat top line, maybe low single digit, high single digit revenue growth at best. And perhaps some of the debt's been paid down, but it's not like it was at 2 times debt to EBITDA at the time of acquisition. And they paid $5.5 billion for it. I don't know the exact revenue number, but I can tell you it's expensive. Vertafore wasn't generating $3 billion of revs and a 40% EBITDA. You have to pay up for assets at this moment. Valuations are frothy, and that's regardless of whether or not it's a fast-growing company or a slow to no growth company like Vertafore. The multiples are obviously different for a fast grower versus a slow grower, but on a scale, on a relative basis versus history for software companies over the past decade or so, valuations are rich. And what happens is when you have a compensation plan, an executive compensation plan like Roper, where the CEO, and I'm not sure if it included other named execs as well, but at least for CEO Neil Hunn, his comp is materially impacted by EBITDA growth, and not so much the growth rate, but the absolute dollar amount of EBITDA. Therefore, you're incented as a management team to go out and close deals, regardless of whether or not valuations are great, regardless of whether or not the asset's great. My preference is to be opportunistic with M&A. be opportunistic with your M&A strategy. If you don't see deals you love, if you don't love the valuation, if you don't love the company, don't do the deal. Sometimes the best deals are the deals that you don't do. Hold on to the cash, even if that means you're building up a cash store, and you may face criticism from investors. Hey, we're not paying you to be a bank. I get it, but there's going to come a time when valuations aren't so rich, and there will be a number of quality companies, and you'll be able to get a deal done at a better price. And that's not to say if the bottom falls out of the market and we're back at March 20 valuation levels again, that you can go out and bottom feed. It takes two to tango. Not every company wants to sell at the bottom. Most companies don't. But there will come a time where valuations are more sensible. But this is that conflict between executive comp and the perverse behavior it can breed in the pursuit of EBITDA growth that isn't necessarily being pursued in the long-term best interest of the company, but is being pursued to drive executive compensation. So it's a problem. It's a problem in the software industry. It's a problem in the capital markets, period. And it's not going to go away unless large shareholders start to do something about it. It can't be just the companies, the institutional investors who are known as activists. You can't leave it to them to change their behavior. It's got to be more of the large, sort of plain vanilla institutional investors, not necessarily go full activists on a company, on a holding, but be more aggressive in voicing your opinion to the CEO. Be more aggressive in voicing your opinion to the board. It's okay to write a letter. The world's not going to blow up. You have, as a large institutional investor, you have a larger voice than you probably think you have. That's all for now. See you next time.